Hello, this is Don Cloud with Cloud Investments. Welcome to our 2019 second quarter commentary. Equity prices falling swiftly from all-time highs? This might not sound like old news. After all, the last three all-time highs were met with heightened volatility, which led to an equity market sell-off. Still, global equity markets made a modest gain in the quarter, and a hard-fought fight in May. In second quarter of 2019, the S&P 500 index, which added 4.3%, while the all-world ex-US index added 3.18%, extending their double-digit gains for the year. Two main factors supported the rally. One, the Federal Reserve provided guidance that they would be accommodative if global narrative takes a turn for the worse, potentially cutting rates. The back and forth trade dispute between the U.S. and China ended, so far, on a high note. However, while investors might celebrate a strong year-to-date return, a different picture emerges when viewing long-term performance. Following January 2018's peak, the S&P index, a common gauge for U.S. large-cap equities, gained only 5.38% after 518 days. The investor experience over this span included multiple market panics, one which led to a drawdown of approximately 20%. Meanwhile, despite all the fears of rising interest rates, the U.S. 10-year Treasury dipped back below 2%. So now what?
Investors would be wise to remember that a gain today can still be a loss tomorrow. Speculation and betting on the near-term direction of any market is a fool's errand. Instead, we believe having a disciplined investment and risk management process, regardless of what the markets are doing, is key to long-term investment success. After all, you can't control the market's performance, but what we can control is process and risk management. Performance numbers shouldn't be used as a guide to build expectations on future prices. Furthermore, being an expert and understanding the complexities and context of fundamentals or news rhetoric doesn't help predict the future either. If anything, it could create more uncertainty. Let's consider the example below of various Wall Street analysts and economists attempting to forecast where the U.S. 10-year Treasury yield would be in 2019. And all were wrong. These projections were most likely not blind guesses, but educated and informed, strong rationales based on assumptions and analysis. But they were still wrong. In the same sense, utilizing performance data to set expectations may only cause disappointment. By chance, the year of 2019 started near the bottom of the 2018 drawdown. The S&P 500 index subsequently rallied quickly to a positive 13.65% in the first 90 days of 2019. This would have put the market gauge at an annualized rate of nearly 70%. Possible, but also highly unlikely. Viewing longer-term, backwards-looking performance is no different. It has been a common, flawed industry practice for decades to build upon and focus on annualized return numbers to select investments and set up expectations. Financial advisors and analysts, for example, may utilize a 10-year annualized performance track record, whether an index, a money manager, or a mutual fund, or as an estimate of expected returns to build asset allocation portfolios and wealth plans. Does it work? Well, let's look at an example. At the end of 1999, the 10-year average annualized return on the S&P 500 index was 18%. Over the next 10 years, the S&P 500 actually lost money with an average annualized return of negative 0.95%. The year of 2019 pushed the bull market rally that started in March of 2009 over the 10-year mark and into the longest expansion period in recent history of 121 months. The expansion in the 90s lasted 120 months before the tech crash. A 10-year look back today would therefore only include a single bull market that as of June 30, 2019 would show an average annual return of 15.49%. This is an illustration of why it is so important to focus on controllable variables such as risk management for both investment selection and expectation setting for investors.
Federal Reserve comments on potential rate cuts may be pushing some indices higher. But the paradox remains: an interest rate cut may be used as a tool if fundamental data weakens, not strengthens. A combination of an expansion cycle seemingly long in the tooth, incremental data supporting a potential slowdown in global growth, and some wildcards of trade risk and central bank actions may be producing more jittery investors reacting quickly to unforeseen headlines. Following the large capitulation in late 2018, current year fund flow data suggests that investors aren't yet fully optimistic again. So far, there have been cumulative equity fund outflows of more than $65 billion versus fixed income inflows of $213 billion, data as of 6/26/19. Yet somehow, everyone's favorite, perhaps misplaced, investment performance benchmark, the S&P 500 index, made it back to all-time highs. It may seem that the S&P 500 index has been driven more by speculative trading and bets, higher on rumors and hope, and falling fast on news and disappointment. As fast money traders like to say, buy the rumor, sell the news. The increased amount of quick reactionary trades on the S&P 500 index may be the cause of its volatility diverging much higher from international equities as of late. In the past 18 months, 90-day volatility of the S&P 500 index was on average more than 50% higher than that of the All-World ex-US index. Most headline optimism and pessimism, such as US-China trade and Federal Reserve comments, have been expressed by investors domestically. Perhaps more accurately reflecting the state of the markets worldwide, international equities still have not recovered from their last peak on January 26, 2018, and are down negative 8.2% from that high as of the end of the second quarter of 2019. Within the S&P itself, investors may be the most cautious since 2013, trying to play it safe. Defensive stocks have been in more demand relative to cyclicals, causing premiums measured by price to earnings to spike higher. Performance aside, investors may be lulled into the comfort of more certainty due to positive economic data points. Indicators such as employment and GDP may show that the U.S. economy clearly surpassed the top prior to the 2008 financial crisis. Even bond yields are arguably higher, and the Fed raised interest rates from the floor of 0. Investors often attempt to point to clues to whether economic data can support a further rally or whether these are all-time high data points or the contrarian indicator. However, the impact of the extreme central bank rescue strategically utilized around the world is still felt today. The amount of negative yielding debt around the world has ballooned past $12 trillion, surpassing levels in 2016, when the U.S. 10-year Treasury yield bottomed at 1.35%.
We approach portfolios grounded by the simple fact that no one can predict the future and that no one can control performance. Therefore, we must focus on what we can control: process and risk management. At the end of the day, we believe that it is important to utilize a dynamic investment process driven by a systematic approach that focuses specifically on drawdown risk. To implement, we believe in diversifying in both asset classes and investment style, meaning having both stocks and bonds, as well as a strategic only and active tactical risk management strategies. Currently, our portfolios are fully invested. And should the markets continue to move higher, the portfolios are positioned to capture market beta. However, we do not attempt to predict market movements. If markets stall and begin to pose higher risk of incurring larger drawdowns, we would expect our tactical risk management strategies to become defensive again, similar to the end of 2018. One of the perplexing phenomena in capital markets is the competition for bragging rights of having called the market. Investment management is one of the few fields where several hundred hours of conducted research can be completely wrong. So why monitor the markets at all? Don't get us wrong, we believe research is important too. That's why we utilize quantitative research to seek to effectively manage risk. But rather than attempting to make market calls on where the market may be tomorrow or next month or a quarter or a year from now, we recognize that will always be a range of outcomes. Naturally, everyone invests with a goal to make money in capital markets. In theory, should always eventually grow, given an infinite time horizon. However, nobody lives forever, and the only thing certain is that uncertainty always lies ahead. In today's narrative of excitable headlines and subsequent panic, yesterday's performance is irrelevant to today and tomorrow. This is why we utilize a disciplined, risk-first approach that is designed to be prepared for whatever may lie ahead.